You want to be greedy when others are fearful, and you want to be fearful when others are greedy. It's that simple.
Recession. This word alone cost more than 8.7 million Americans their jobs between 2007 and 2009. These alarming figures are enough to explain just how badly an entire country and even the whole world is affected by a recession. But what if there is a way for you to actually profit from a recession? And luckily there is. There are 7 top secret rules that billionaires like Warren Buffett don't want you to know, and today I'm about to explain every one of them, with emphasis on the last one, which is the golden rule. However, before I begin, let's talk a bit about some of the latest money moves the biggest investors in the world have taken the last year. Everyone knows Warren Buffett. He's a multi-billionaire investor, and his returns have been legendary to say the least. But did you know that despite being an investor and a businessman, he actually prefers market crashes? Why is it that every time the stock market crashes, investors like Warren Buffett invest huge amounts of money into the market? Well, it's because Warren sees market crashes as something others do not, an opportunity. Which could be why he once said that he hopes to see a lot more recessions. And now, it seems as if Warren is preparing for a crash like the one in 2007.
Under current conditions, building the cash position, I think when I look at the alternative of what's available in the equity markets and I look at the composition of what's going on in the world, we find it quite attractive.
In the first 9 months of 2024, Warren dumped $133 billion worth of stocks and spent only $6 billion buying new ones. According to Buffett, he's busy stacking cash because the valuations are at a historic high right now, just like he did right before the 2007 recession. Looking at this, it seems as if they're almost preparing for another recession to hit very soon. And if Warren Buffett is investing only a shred of what he normally invests, it's pretty safe to assume that you might do the same. So coming to the point at hand, here are the 7 most important and unknown secrets that will help you profit from a recession. Rule number 1. Understand the rules of the game. To begin with, the most crucial step is for you to understand the game. If you've been investing for some time, you probably know some of these rules. However, most beginners and young investors enter the market blindly without understanding how it works. You see, during a recession, everyone automatically thinks that investing money into anything, be it stocks, real estate, or crypto, is stupidity. I mean, after all, the market has crashed, right? Well, if you think the same, let me tell you, you're missing out on the golden period of investing. According to Warren Buffett, a crashed market is the best time to invest money because the shares and stock prices are at discounted prices. It's your chance to buy every high-value stock at a fraction of the price. Like buying a $100,000 house for only $65,000. Sounds like a pretty good deal, right? Making the mistake of thinking that nobody would be able to make money during a recession is what many do. And that's a limitation that puts your bank account on hold. The imperative thing to keep in mind is that there are always winners and losers in every game, no matter the circumstances. The same is true with the stock market. If the stock market has crashed, the winners are those who scooped up the stocks at discounted prices. And the losers are those who held back, secured what little money they had, and waited for the market to recover. And talking about recoveries, this brings me to the next rule. That is rule number 2. Nobody can time the market. You see, timing the market or understanding when it will boom or bust is nearly impossible. It's dependent on multiple factors at the same time, and understanding or predicting it in any way, there's simply no way to do that consistently over time.
The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday.
However, what you can understand is how to identify the right time to invest so you can fill up your pockets in the long run. And first of all, understand that bad news in the economic market is your best friend. You're being given the most precious information in a negative way. And now, it's up to you to either sit back and just nod your head in disappointment or actually get up and start investing right away. For example, if a Fortune 500 company stock crashed today, The smart investor would buy as much stock as they can because they know that eventually they'll make their money back and then some. And surprisingly, this is exactly what Warren Buffett also suggests.
When stocks go down, it's good news, just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news.
Undoubtedly, one of the most important rules to remember is that the market will always bounce back.
Let's talk a little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow.
You see, if there's one thing super investors like Warren Buffett knows for absolute certainty, it is that the market will always bounce back. It always have, always will. Knowing this rule has allowed Buffett to make billions of dollars by not being scared to invest when everyone else is selling their stocks out of fear. And the recovery from the 2007 crash is proof of this. Once you realize that the money you're investing in stocks during a recession is actually your investment in the future of, let's say, America, then you'll understand the game entirely. However, this doesn't mean that you start investing in companies that you otherwise wouldn't. In 2023, Warren Buffett talked to CNBC and said that the best approach before a recession is the business as usual approach. You see, if you suddenly stop investing, then you're risking losing out on massive profits that you could have made. At the same time, it's important to keep in mind to not invest in companies that don't have promising financial statements. In the words of Buffett, we just want to buy good companies run by people we like and trust and at a decent price. And this is a motto that every investor, no matter how experienced, should always follow. And here's a little tip. Find companies led by individuals who personally own a significant share of the company's stock. There are countless examples of people who lost their hard-earned money in the stock market simply because they didn't understand it well enough and treated the market like gambling at a casino. Hence, conducting your own research is not only important, but the most crucial step that should be taken before you even make up your mind about investing. You see, investing is all about figuring out what something is worth and paying less. And if you don't know how to value something, then you have no business having a very concentrated portfolio. Then you should invest in something else. But what should I invest in? You might think. For example, investing in simple and boring index funds, just like the S&P 500. This is a safe and secure bet, and they have actually outperformed more than 90% of all active fund managers, and it's been known to consistently deliver great returns.
Single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million.
Now, to get a better insight, look at it this way. Back in 2007, when the market crashed, the S&P 500 lost nearly 35% of its value. The people who hold on to their shares back then, or even bought more shares in the S&P 500 back then, and still have them in their portfolio today, have a profit of 505%. That's almost 11.5% return on your money per year for doing absolutely nothing for 16 to 17 years. But when you do make up your mind about investing, don't forget that the market will always eventually crash. It's simple economics. After a boom, a bust is a must. There is simply no way a market such as today's would hold up forever. Economic disasters are inevitable, and therefore, you better be ready to see your portfolio drop to the point where it's sometimes heartbreaking. But it's all the name of the game.
If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it?
Investors like Warren Buffett is clearly comfortable seeing the value of his portfolio suffer 30% drawdowns, whereas the vast majority of people are not and would either sell their stocks in panic and make huge losses, or get very sick from worry. There is always something to worry about. You should try and avoid weekend thinking and ignore the latest dire predictions or the news or your broke uncle giving you stock advice. Only sell a stock if the company's fundamentals deteriorate, not because the sky is falling. Now you might be thinking, Warren can afford riding out the economic downturns. Well, so could you, if you had the right investment strategy. But more on that a little later. The thing to remember at this point is, as humans, we have natural tendencies. When we suffer losses, we start to think about recovering as much money as possible. But on the other hand, if you're a rational investor with a plan, you would wait it out. You already know rule number 3 by now, that the market will always bounce back. So, waiting for that is better than cashing out at the worst possible time. But this doesn't mean that you don't have to be prepared at all times. And that's the next rule. Rule number 5, always be prepared for anything. When the economy is booming, most people tend to spend more and more money on everything. Houses, cars, expensive clothes, and anything really they can get their hands on. They're all assuming that they'll make a handsome profit just because the market has been going up for, let's say, 5 years. But since you are a smart investor, you know that a crash can happen anytime soon. Weak companies with unimpressive financial statements have a low chance of recovering back. And you should never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. However, if you invest in bigger, safer, and more well-respected companies with good balance sheets and wait through a crash, your chances of multiplying your investment go through the roof. Here, you should jot down a small checklist that will always help you before you invest your money. 1. Save your money. 2. Spend only what you need to. 3. Build up your capital. 4. Avoid debt as much as possible. You see, these 4 pointers will help you more than anything else. You should control your money smartly because it has a tendency to vanish very quickly. Coming to the next point. 6. The collapse. According to Peter Lynch, people have lost more money while waiting for a recession than in a recession. We know that the market will always eventually crash, but as discussed before, nobody can time it. The smart way is to always be on the lookout for great, promising, and profitable businesses that are on the rise. Aim to invest in something that offers true value instead of just a high stock price tag. And also, don't listen to unnecessary hype. It will only instill fear that can lead you to massive losses. Look at it this way. If you buy a house for $1 million and the market crashes, plummeting its value down to, let's say, $600,000, would you sell that house just because you have a chance of recovering 60% of your money? I know I wouldn't. It's stupid. Well, the stocks are pretty much the same. Panicking will almost certainly land you in a sea of trouble. And since it's your money at stake, making the mistake of trusting anybody other than yourself isn't suggested. Now that you know what to do, where to invest, and what to look out for, let's talk a little about the real thing. Number 7. The profiting. In the world of investments, profiting is always the first, middle, and last goal. After all, why are you even putting your money at risk, right? It's important to know that the stock market isn't built to get rich quickly. It can give you an adrenaline boost for sure, especially when you make your first profit. But don't let it carry you away. The most successful investors in the world look at the stock market as the go-to place for creating true generational wealth. It can literally take your bank accounts from just a few $1,000s all the way to millions. The trick lies in patience, research, and how well you understand the stock market. At this point, you might be wondering, what are the top secret rules? Because all we talked about was common sense. Well, you might be shocked to know that these simplest rules are the secrets that many don't understand, and those who do, they often mess up because they're looking for a way to get rich quickly. But the last thing, or the last bonus rule I'll leave you with, is to never ever follow the hype. Don't listen to your broke brother-in-law that acts like he knows everything about the stock market. Don't listen to Jim Cramer on TV and completely ignore bad headlines. The focus should always be on real intrinsic value. Look out for companies that are operating with low capital and don't need to take on any debts for whatever reason. That way, you know that your investment is a lot safer. To understand this better, with a little more technicalities, just look at this graph. For example, the blue line indicates the actual value of a company. And it's the one you have to focus on, since that's your guideline for investing. Ignore everything else surrounding the company. The blue line is the secret to every great investor. What matters most is the fundamental value, especially during a recession. So, why would anybody want to listen to anything else? Right? And moreover, don't invest more money than you can afford. And don't invest money that you might need for unforeseen bills in 6 months. Find out the number you can afford to invest each month and concentrate on a few companies at a time. You see, if you invest $1,000 in a stock, all you can lose is $1,000. But you stand to gain $10,000 or even $50,000 over time if you're patient. The average person can concentrate on a few good companies, while the fund manager on Wall Street is forced to diversify. If you own too many companies, you'll lose this advantage of concentration. And it only takes a handful of big winners to make a lifetime of investing worthwhile. And if you don't know how to value something, then you should learn how to, or do something different, like investing in an index. The S&P 500 is a great bet where you can invest every month through the highs, the middle, and the lows, and make it automatic. It's been through it all, the ups and downs, and it always bounces right back.
Practically all of the time. And that is to consistently buy an S&P 500 low-cost index fund, keep buying it through thick and thin, and especially through thin, because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. Just keep buying it. American business is going to do fine over time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. And then since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company. It's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500.
This graph shows every major event that the S&P 500 went through and still came back. Go back to the third rule I explained, and you'll understand why Warren Buffett and other investors wholeheartedly believe that the market will always bounce back. So, if you're getting ready to start investing, always remember these 7 rules, and you'll be a lot safer than going in blind. Please note that this is not in any way a suggestion to invest in a company or a method that is guaranteed to work. These are simply rules that various investors like Warren Buffett and Peter Lynch have emphasized time and time again. Therefore, it is advised to always conduct your own research before investing your hard-earned money. And if you made it this far in the video, I really salute you. And I thank you very much for watching. If you're up for it, leave a comment about your thoughts, feedback, questions, or whatever it might be. It would be great to hear from you. Take care.